All right, good morning. I'd like to call the meeting to order and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Ojibwe, Innu, Cree, and Dakota peoples, and the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation and Treaty 3 territory. My name is Neil Harden. I'm chairing today's panel. With me via Zoom are Gail Anderson and Michelle Duncan. The assessor today is Sharon Tang, and the administrative personnel is Zachary Mohan. We will be hearing applications for revision of the assessment rule in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the board. The board is appointed annually by council and is independent of it and the city administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that be mailed to all parties as soon as possible. Please note that the board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value reclassification, or to the Court of King's Bench for the matter pertaining to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony followed by questions the applicant may have, then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You will receive the board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We will be hearing items 4 and 6 on our docket today. Mr. Mohan, please affirm the assessor's and applicant's testimony.
First, Mr. Chair. Madam Assessor, please state your full name. Oh, sorry, I believe you're muted at the moment.
Sharon Tang.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Mr. Applicant, please stand. Please state your full name.
My name is Jared Story.
Do you affirm that the evidence about to give at this hearing is the truth, the whole truth, and nothing but the truth?
do.
Thank you. You may be seated.
Thank you.
All right, good morning once again, everyone. Our first property today is 460 Martin Avenue West. So, Ms. Tang, can you lead us through the information starting with the pertinent data?
File number is 24-3060. Roll number is 14099997700. The address is 460 Martin Avenue West. The assessed value for 2025 is $1,348,000. Page 2 of my brief shows the property information. So there are 14 buildings. Well, there are 7 buildings altogether, but I think the system split the number of buildings and then divide what depends on each individual units. So there are 14 units for the property, and there are 2 stories. They're built in 1977. There are for total 14 suites. Doesn't look like there's any outdoor parkings, so the parkings are only available on the street. And the bottom of page 2 and the page 3 of my brief shows the subject property pictures. And there's page 4 of my brief shows that there's no sale history for the subject property. And page 5 of my brief shows the workup for the property value. So the average rent for the subject property is $930.92. The gross potential rent for the property is $156,395. The expense ratio is 57.53, and that gives us a net operating income of $64,694. And we applied 4.8% cap rate, and that gives us a total value of $1,348,000. And page 6 and 7 and 8 of my brief shows the comparable for the subject property. And that concludes my presentation.
Okay, questions, Mr. Story?
Yes, sir, just a few. So Ms. Tang, this assessment is all modeled, is that correct?
That is correct.
Okay, and have you visited this property at all?
No, I haven't.
Okay, and just so the board's clear, this is indeed a social housing asset, not a market apartment, correct?
That is correct, yes.
Okay, and then I guess, and Mr. Chair, in the sake of expediency, we're just talking about cap rate on this file, so I'll limit my questions to those matters.
Okay.
Ms. Tang, so I couldn't help but notice when I look at the city's cap rate table on page 9, it's showing us that the city of Winnipeg, April 1, 23, 20th percentile for all high-rise, low-rise, quality A, quality B is 4.75. So does it seem at all peculiar to you that a social housing asset in Elmwood is being outputted by the model a cap rate that would indicate that it would be a very good investment or a very safe investment? Does that cap rate not look extremely low based on what we know about the property on a site-specific basis?
The cap rate is shown on page 9. It is a citywide cap rate, so it's kind of like average, and it shows the lowest value and the highest value. But sorry, the 20 percentile and the 80 percentile. But when we're assigning the cap rate for each individual properties, we do take consideration of the location of the property, the condition of the property, and the other factors. So if we assign 4.8% for the property itself, that means we have already considered other factors. We're not just looking at citywide.
Okay, I think I will leave my questions there then based on what was presented here, Mr. Chair, and thank you, Ms. Tang.
Okay, Ms. Anderson, any questions?
Just in regards to the cap rate, then again, it's model generated, the cap rate?
That is correct.
Okay, and so you said it is taking into account the factors of the location and that it's social housing?
That is correct, yes.
In what manner? Like how can you explain that further?
I'm not too sure how exactly the model works, but we do take a look at the values before we send the assessment value out for the 2025. So when we were reviewing the value before it was sent out, we would look at each property and see how much increase the value has compared to the previous cycle. So if there's any discrepancy in any ways, we would change the value or we would overwrite the data information. So if we have already reviewed the data and we think that the 4.8% is a good indicator for this property, then that means we believe that this value is correct.
Okay, so this was reviewed and it was determined that the value was accurate.
That is correct.
Okay, thank you very much for your presentation. I have no further questions.
Okay, Ms. Duncan?
Yeah, just sorry, just on the cap rate component. So as the model assigns a 4.75 for one of the best properties out there, and a 5.45 is one of the worst, just figuratively speaking, based on the range. And the model has put it at 4.8. Yet in the description, it describes it as it being in poor condition. It's acknowledged that it's a social housing, which comes with a few challenges. I'm a little perplexed on why and I know you can't speak to the model, but again, it's about the assessment of the property, why it would be on the low range of the cap rate. Any thoughts in that regard?
I guess we'll be looking at so for page 10 of my brief that shows the cap rate evidence. So I think they will be looking at 459 Sergeant Avenue. So that's also in a similar, I guess, area and the condition. So that one has a 4.72% cap rate. So we will be looking at the sales and determine what the cap rate would be for the subject property.
Right. So when I look at that study, same thing when I'm trying to look at effective age. When I look at 32 Arden, it's at a 5.02 cap rate. It's got an effective age of 1985, a little bit higher, but year built 69. And then there was one other one in here. I think it was, 1 second here, Maryland, 677 Maryland. So an effective age of 1972. This is an effective age of 1975. And it was issued a cap rate of 5.5. So I'm not finding tons of support necessarily within this study, although there's a lot of properties. I haven't looked at them, line by line on any stretch, but I'm just curious. Social housing, city assesses it at poor condition, yet it's one of the fairly low on the cap rates. So you've already kind of answered. The evidence is in there, you feel. So that's sufficient. Thank you.
Okay. And I have no questions that haven't been asked and answered. So Mr. Story, you can begin.
Thank you, sir. Okay, so once again, we are at 460 Martin Avenue. I've handled this property a number of times. I visited it last, I believe it was this past weekend, but very recently. And I did note they have done some cladding work on the exterior. So I will adjust my position based on that new information once that has come to light since we viewed the property. However, this property is in Elmwood. It abuts a hydro substation. It dead ends right into a hydro substation, the Martin Avenue substation. And it is a set of, let's call them side-by-sides. So we have 7 buildings and they are side-by-sides. There is parking. It's just, it's uncovered. It's exposed parking between the buildings. You can see. So ultimately, and this is just to give you some orientation, this is just west of Watt Street. So we'll call that we'll call that the Chalmers section of East K, but I think we're a good sense of where that is, typically right off of Watt. Again, it is social housing, so it does not achieve any economic profit. It was in extremely poor condition in the last cycle, but we have seen that they've done some cladding, presumably to maintain the property. So we are only disputing the cap rate in this instance. The rent applied of $931 per month per door is fine. The expense ratio of I believe it's 57.5% is maybe a touch low, but basically what we would expect to see in this type of building. We have to consider that duplexes or what we'll call commercial row houses typically have higher expenses. We have stucco buildings or wood frame buildings with stucco exteriors, so that's those expenses typically run higher. And then we have to also consider that these properties are typically less efficient than what we will call what you would consider a regular or a more typical vertical apartment. So each of these units will have their own HVAC, they'll have their own hot water tank, and of course you have multiple buildings. So typically we do see the model, at least from my perspective, we do, I suppose I can say on occasion, we'll see that the model captures the inherent elevated risk of having multiple buildings. But in this case, I think we've uncovered here that the model is suggesting that this is a very good or very safe investment, and we oppose that. We don't believe that to be the case. We always adjust for social housing. So I provided you with a cap rate study, and I'll go through that very quickly, but it's summarized on page 19. And effectively what we're saying is the cap rates for this cycle generally ought to fall, as a broad comment, somewhere between 5 and 6.1% for the majority of properties. Now, there will be outliers, and you will certainly see social housing properties as high as 7.5%, depending on condition, depending on location. And again, depending on building type and construction. Once again, in this case, we have side-by-sides, which we classify as commercial row houses, but indeed they are side-by-sides, 7 buildings on site. No amenities for social housing, that's an increased risk. No history of economic profit. That's under the adjustment of durability and quality of income. So these properties typically do not receive any, well, they don't receive any economic profit as social housing assets over their life. And then occasionally after a number of years, they will receive some injection of capital to keep them functional. But it's not like in the private market where we see an injection of capital in order to maintain competitiveness with other assets. We would suggest that this is a below average property. And then there is that proximity to the substation. I have not made an adjustment, but it is worth noting. It's striking when you go down that street and you dead end right into a brick wall with a substation behind it. It's a bit unique. So in this case, we've applied initially a cap rate of 6%. However, based on the fact that there has been some work done, and I want to be very clear, Mr. Chair, that when we see issues that give us concern, we'll adjust accordingly, but we also adjust the other way. So when we see that there's been some amelioration, we want to make sure that we're being fair and clear about what's going on with this property. So I've adjusted my cap rate down 25 basis points. So that is only a tick above the 5.5, which should be the baseline for a late 70s build. And in this case, we're not adjusting for, well, we're considering location, we're considering social housing, and we're considering 7 buildings. So I think that a 5.75 cap rate is maybe a bit light, but ultimately the resulting value I think is very fair at $1,125,000. So we do respectfully submit that the value for this site will not exceed $1,125,000. I've included, just for interest's sake, let's say, the leading orders from the board, the municipal board, talking about how we ought to adjust for social housing. I've included some verbiage from Mr. Richard Polton. He's an appraiser who wrote the book about how you ought to value income limited properties such as social housing. And effectively, his methodology is the same that we use. We look to baseline market cap rates, and then we adjust based on what he calls the 4 factors. So we have low income tenancy, we have issues related to location, so the neighborhood in decline, let's say. And he also talks about, low income tenancy is a major one, as well as the fact that, no history of economic profit. So, and then of course we have high operating expense ratios as well. So, and it's very low quality or low cost construction. So in this case, we have wood frame with stucco. So we've included those decisions. We've included that discussion from Mr. Polton. And in many cases, we would be looking to adjust social housing cap rates much higher, because one of the best quotes, I think, that sums it up very succinctly is that any investor looking to a higher risk property would require a higher yield, so higher risk, higher reward. So it doesn't frankly make sense to have a yield rate, a cap rate that's only at 4.8%, only a touch above what a GIC was returning at that time, at April 1, 2023. the risk factor has to be adjusted, because otherwise you would not typically see an investor purchase a high-risk property with a low return rate. So, Mr. Chair, if I may flip to my capitalization rate study, I'll be very brief. I think we've covered many of the issues. And then I'll summarize quickly in the next file as you will have heard it by then. But if you'll all let me know once you're at that Altus Group 25 cap rate study for apartments, I can just go through.
Yeah, I have it, yes.
Okay. Wonderful. Okay, thank you very much. So on page 2, we simply talk about we start with what is a cap rate, and effectively the cap rate we've described it a number of times as a we'll call it the numeric representation of risk. So the higher the risk, the higher the cap rate as a general comment. But it does also represent, as I mentioned, the required or acceptable rate of return on a real estate investment. So if we think back to April 1 of 2023, we'll recall that inflation was running extremely high, 4.3 to 4.4%. That's between March and April of 2023. And lending rates were very high. And GICs, of course, were returning 4.5%. So one of the major influences on the cap rate is, of course, the required return, but looking at the required return in other investments. So it would not be logical to take on a great deal of risk. For example, Ms. Tang talked about the cap rate they have for Sargent at 2.99%. I would suggest that well, without seeing the calculation, there seems to be something off there. It doesn't make sense that somebody would purchase a property that returns 2.99% on Sargent Avenue when they could very simply go into a very low risk investment through some other vehicle such as a GIC. That's just a logical conclusion, I think. So the assessor cap rate samples, it's now on page 5. They should go back here. Before we get into the hearings, a document is made available to all the ratepayers. It's called Evaluation of Income Producing Properties. I have it in its entirety in my cap rate study, but just very broadly, it does say the cap rates for apartments range from 3.5% to 7.95%. So that seems to be like a very, very broad range. Once again, we haven't seen all those calculations, nor are we aware of what goes into the assessor's model in order to come to those conclusions. Altus, on the other hand, has been very, very transparent with our conclusions. We've mentioned the various factors that we consider when we apply cap rates. It's not modeled. This is all done by human analysis, let's say. We consider the building type and construction. In this case, row housing should be a factor. Heritage is not a factor today. We consider amenities. So buildings with a greater amount of amenities typically have the capacity to command a higher rent. They're more competitive and should rightly be applied a cap rate that's lower to indicate less risk. We consider condition. Now, in terms of most of the social housing assets that the board will hear this cycle, condition will be something that comes up over and over again, and that is, of course, due to the fact that there is no economic profit due to the fact that these are rent geared to income properties. Parking, suite mix, we consider suite sizes, number of suites, and then location and external factors. So once again, I think we've been very fair with the file in front of us today with a 5.75 cap. As you can see that a number of these factors would indeed be checked off. Page 11 is the summary of the cap rates that we've calculated. We have one on Talbot. That's not too far away from where we are. I think the assessors actually used a cap rate, or sorry, a rental comp on Talbot, quite rightly. That property was built in 1970. They were asking $2,750,000, and the sale price that was achieved was $2,195,000. We calculate that cap rate at 6.48%. 677 Maryland. I've worked now for the past 3 owners of this property, so I know it quite well. I've visited many times. You'll see now the assessor didn't mention this one in their presentation, so I'll just speak to it very briefly. But We are using a more recent sale. So the sale that is included in chief evidence from the assessor is in fact a sale that was germane to the last cycle. We've used the current sale. We calculate that at 7.11. 738 St. Mary's was upgraded throughout 2018 prior to its sale in 22. It's from 1959, so it has a cap rate of 5.26. So that speaks to or supports my comments on condition, I would suggest. We have another one on Maryland, asking price $2,350,000. It achieved $2,050,000, cap rate of 5.44, and 2390 McPhillips, which we talked about a number of times in the last cycle. Now the window has moved. We are now permitted to talk about what happened after the reference date and certainly after the sale. We can now confirm that that purchaser purchased that property clearly with the intention to elevate those rents, as at the time of acquisition they were indeed below CMHC. We were not permitted to talk about that last cycle because the reference date, the window has now moved, and that is now fair game. We can talk about it. They were asking $20,440,000. They achieved $19,400,000. We're suggesting that cap rate ought to be somewhere in the range of 5.6%, 5.59 based on our calculations. I've summarized our findings. I've taken you through a very quick tour of our cap rate inputs. The balance of the brief contains all of the it contains the document that I mentioned called the valuation of income producing properties. That's the document that's put out to ratepayers in support of the assumptions of the assessment department for the various asset classes under appeal in 2025. And then the balance of the brief just shows all of our calculations. So I've been critical of the city for not showing calculations, but I want to point out that and be very clear that we have provided you with all of our assumptions and all of our calculations in this document. So all that to say, Mr. Chair, we believe that 4.8% cap rate is too low. We think that this property ought to be applied somewhere in the range of 6 to 6.25. However, given the fact that there has been some work done on the exterior envelope of the building, I am adjusting my cap rate down to 5.75. The NOI is not in dispute, so adjusting that cap rate from 6% to 5.75 leads us to an indicated market value of $1,125,000. And I do respectfully submit that the assessment not exceed $1,125,000 for this assessment cycle. And with that, I'm very happy to take your questions, and I thank you.
Okay, Ms. Deng, any questions?
We don't have it. Well, I don't have any questions, but we do have the rebuttal for the cap rate study that Jared provided.
Okay, we'll deal with your rebuttal after the questions then. Okay, Miss Duncan, any questions?
Just to confirm, so you've reduced your cap rate by 0.25 solely based on the cladding work on the outside, no other improvements inside?
5.75 is the adjustment. I haven't toured the interior, but I think this property in the condition that it was in previously would fall between 6 and 6.5, something like that. But in consideration of the fact that they have done work here, 5.75 is our cap rate today in front of the board. Yes.
How long ago would you have seen the inside?
Oh, good question. I suppose I would have seen photos sometime in the last 2 or 3 cycles. Now, I do handle a number of these properties. I have a pretty good sense of what they look like. They are Spartan. Again, they're not meant to compete. They're housing assets, so they're not. They're very basic, let's say, and that's the nature of social housing. But I have not been inside for this assessment yet.
Okay, thank you. No other.
Okay, Ms. Anderson, any questions?
I have no questions. Thank you for your presentation.
Okay, now Ms. Tang, you said you had some rebuttal.
That is correct.
Okay,
Sir.
Zachary, is it in the
SharePoint?
yeah.
Yeah, it should be in there. I just deployed it. Might have to refresh your thing and I'll send it to you. Yeah, should be in the SharePoint right now, just might have to refresh, that's what I'm trying to say.
Rebuttal. Okay, I see it.
Perfect.
Okay, does everybody have it open?
Yes, indeed, sir.
Okay.
Yes.
Then you can proceed, Ms. Tang.
Okay, so as the rebuttal shows that we have shown a few of the well, I guess we have shown the workup for all these properties. So basically for subject for the comparable 1 to 3, we have labeled it. So for 345 Talbot, that's sales 1, 677 Maryland Street, that's sale number 2, and 738 St. Mary's Road, that's sale number 3. So from the notes, we can see that for these 3 sales, it looks like they're only using 1 year income and expense information, which is not sufficient to calculate the stabilized net operating income. So for our standard, we don't use just the 1 year information. We use 3 year stabilized information. And for 100 Maryland, it doesn't look like there's any income and expense information provided to us at all. And it doesn't look like, I guess, the agents, sorry, I guess it doesn't look like their workup shows their income information either. So we're not too sure exactly where they get the income, the net operating income from, or how they, I guess, get the cap rate study for that one. And for 2390 McPhillips, we have shown the detailed workup in our rebuttal. So that supports, I guess, our 4.8 cap rate. And that's my rebuttal.
Okay, Mr. Story, questions on the rebuttal?
Yes, indeed, I have a few. Okay, I have seen this document before, staying, so I'll try and run through this very quickly, but on 345 Talbot, I understand that the contention, or sorry, I guess you made an overarching comment that 1 year of income expense information is insufficient. Is there anything in the appraisal literature that suggests that that is not, that using the expected income and the expected expenses is not a reasonable methodology for deriving a cap rate? Is there anything that you're aware of that would suggest that that is not insufficient, that is not sufficient?
Not that I know of.
Okay, and if I look at Talbot, I know from a previous file, the point of contention was that we are using the expected rents from the sale brochure. And Mr. Chair, this is on page 2 of the assessor's rebuttal, and you can see in 2021, the report states 255,408. The sales brochure suggests an average rent of 924, well in range of what we would expect going forward. And that is calculated to be 266,112. So Ms. Tang, can we agree that rental escalation between 266,112 and 255,408 mathematically equates to $37.17 per door per month?
I'm sorry, I don't only see the sales brochure.
Okay, well, you're rebutting our cap rate study, and it's in our cap rate study. So have you not reviewed that?
Sorry, which page is it on?
It's on your page 2. When you're saying that you've taken our workup, and we're saying that the average rent from the sales brochure is $266,112 or $924 per door. And I believe that the point of contention from the city is that we ought to have used not the expected rent, but rather the rent in place of $255. And I suppose what I'm suggesting to you, Ms. Tang, is the adjustment above what was being collected in 2021 equates mathematically to about $37 per door. It's nominal.
Sorry, I'm looking at your cap rate study, and I'm looking at page 34.
Yeah.
Would that be what you're referring to? But I don't really see any sales brochures here.
Right. Oh, okay, so if we don't have the sales brochure, that's fine, but, hold on. Well, no, it's there, we have
Oh,
property.
is it a oak arm?
That's right,
Oak arm, okay,
yeah, and that's the sales brochure, that's on page 48,
okay.
and it explains, let's see here, where we start, okay, the offering. Offering price per suite 114.5, stabilizing at a 5.2. That's if they were to achieve the exact value they were requesting or they were putting to market. And it also says, let's see here, expected rent is in here. So we have the municipal address, the neighborhood, property taxes. It's in here somewhere. Okay, maybe I don't have that in the, no, it should be here. Okay, well, at any rate, that's fine, I'll leave that there, but the point is that the expected rent that the purchaser was looking to achieve was again $37 higher per door than what was being achieved. So I'll leave that one there. Now, the last comment that I have is, okay, 677 Maryland. We have included details here. Again, we've handled this property a number of times. We have the most recent rent roll. I suppose the reason, would you not agree that it's somewhat difficult to Frankenstein a bunch of rent rolls together or statements together when you have 3 different owners in a short period of time, in about 5 years?
I guess each of them would be able to provide the income and expense information themselves.
Right, and we did mention to you that that rent was from the most recent rent roll.
Right.
And that's from November of 2022, correct?
That is correct.
Okay, and we have indeed provided you an itemized breakdown of the repair and maintenance, correct, as well, correct? Page 50. Okay, and income statements, okay. Now 738 St. Mary's, it's the same question about methodology of looking to what was put to market. But I guess my last question now is, and 2390 McPhillips, we've heard a lot about in the last cycle, and I suppose we're going to talk about it again. But why has the city not looked to what happened on acquisition in order to get a better sense of the purchaser's motivation?
What do you mean?
Well, what I mean is, well, I suppose I'll ask you a question. Can we agree that at the time of acquisition, an independent owner sold the property to a real estate investment trust, so a very knowledgeable purchaser, and that purchaser would have known upon acquisition that those rents were low, and in fact, they were below CMHC. Does that not raise a red flag to the department for a relatively new build, let's say?
I guess we wouldn't have that information regarding to if there's any intentions hidden behind the purchasing, I guess, transaction. We would send out the sales verification, but if they don't submit that information to us, then we wouldn't have that information available to us.
Okay, but given the fact that this has been a contentious issue for multifamily appeals, you are able to look to what has happened between 2020, October or September of 2020, up to April 1 of 2023, but you've not included any analysis to that degree here, correct?
To generate the cap rate,
Precisely.
I guess we do have a 2023 sales for March 31st, 2023, and that's the 727 Surgeon, and that gives us a 2.98%
I
cap
know
rate.
I'm concerned, just standing right now about the Lady Joyce at 2390 McPhillips, and I guess, just to summarize, just very quickly, can we agree at the very least that mathematically, that if those rents were indeed higher, then that cap rate, all things held equal, would indeed decompress, it would be higher, mathematically.
Well, again, we don't have that information available, and we're only using what is provided by the owner on the income and expense information.
Okay, so
So
you're
you-
suggesting that the current owner of 2390 McPhillips did not submit an income and expense questionnaire for 21, 22, or 23?
We're not looking at those information because that's what happened after the sales.
And why would you not look at what happened after the sale?
Well, I guess we can use those as a reference, but we're not going to use those information to calculate our cap rate.
I think those are my questions on the rebuttal, Mr. Chair. Thank you.
Okay, Ms. Anderson, any questions on the rebuttal?
I have no questions. Thank you.
Ms. Duncan?
No questions, thank you.
All right, Ms. Deng, do you wish a summation on this one?
No, that's fine.
Mr. Story?
Yes, sir. Just very briefly, I think we've established the nature of this property is indeed a social housing asset. There are some concerns with location, with external factors, with the type of construction, with the number of buildings. So I think we've been very reasonable in applying only a 5.75 cap rate. So I'll leave it there, but we do respectfully submit that the value not exceed 1,125,000 based on our submission today. Thank you.
Okay, thank you. We will move on to 1415 Rothesay. Okay, let me just open the files. First of all, does anybody need a break between files here? Okay, then we'll just proceed on with Rothesay. So Ms. Tang, you can proceed with 1415 Rothesay.
File number is 24-2946. Row number is 0400173270. Address is 1415 Rothesay Street. The assessed value for 2025 is 2,849,000. Page 2, my brief shows the property information. So there are three buildings on the property, and there are 2 stories, and they were built in 1975. There are a total of 22 suites and 24 outdoor parkings. So page 3 and 4 of my brief shows the subject property photos, and there on page 5 shows that there's no sales history for the subject property. On page 6 of my brief shows the workup for the valuation. So there are 22 2-bedroom suites, and the average rent is $1,106.56. And that gives us a gross potential rent of $292,132. And the expense rate is 50.44%. And the net operating income is $141,017. And we apply a 4.95% cap rate, and that gives us $2,849,000 for the market value. And page 7 and 8 and 9 of my brief shows the comparable properties. And Page 17 of my brief shows the advertisement for the subject property. And page 18 to the end of my brief shows the income and expense information submitted by the owner. And that's my presentation.
All right, questions, Mr. Story?
Just a few, Mr. Chair. Ms. Tang, this is all modeled as well, this assessment, is that correct?
That is correct.
Okay, have you visited the property?
No.
Okay. Did you review the actuals in preparation for this assignment?
Yes.
Okay. Okay, I think, Mr. Chair, I'll leave my comments for my presentation. I think those are my questions of the assessor. Thank you.
Okay, Ms. Anderson, any questions?
Yes, thank you. So you indicated, Ms. Tang, that this was all model generated. My question is in regard to the vacancy rate of 2.6%. Just wondering how that is determined.
I guess we would be looking at the market information, and we would collect the information from the income and expense information submitted by the owners, and we would use that information for the market region and generate the information.
Okay, and with regards to the expense rate of 50.44%?
That would be the same.
Okay. And then the cap rate too, has it been reviewed, or you've got your comparables there? Which do you believe is the best comparable?
I would say 2390 McPhillips will be the most compatible to my subject property.
Okay, thank you. I have no further questions.
Okay, Ms. Duncan?
Are any of these comparables social housing as well?
No, this is not a social housing property.
Okay. Oh, sorry. Thank you. No other questions.
Okay, I note that your modeled NOI is very similar to the actuals presented by Mr. Story. So I guess the issue is going to come down to mainly cap rate again?
I would assume so, yeah.
Okay. All right, so I'll have no further questions on that. So Mr. Story, you can give us your presentation.
Yes, thank you, sir. And just on that point about cap rates, the assessor's not gone through them, but they are in evidence. So I would like to submit my rebuttal document to the assessor's cap rates and just go through it very, very quickly, if I may.
Okay, do we have that in our package?
I can upload that, Mr. Chair,
Okay,
now that it's been addressed.
Yeah, Mr. Story, we deal with your main presentation first, then we'll deal with your rebuttal.
Certainly. Yeah, no, it's wonderful. Okay, so I will just go through this very quickly. Mr. Chair, you're quite right. This is essentially going to be an issue of cap rate. We have provided a detailed workup. And again, this is not a social housing asset. This is a market apartment. So this is rented on the free and open market. We've stabilized 3 years of data as reported to the city by the owner. And you can see very clearly, Mr. Chair, that our NOI is 139,877 and the city is 141,17. So we had initially suggested a cap rate of 5.75, and I am going to, similar to the last file, after reviewing this property, I visited it yesterday. It is in good condition. We do have concerns with commercial row housing in general, or sometimes in marketing parlance, you would call this a townhouse. And we do think that there should be some adjustment for multiple buildings and wood frame construction and stucco and that sort of thing. But ultimately, based on the fact that these rents are reasonably high, based on the fact that the commensurate vacancy is not super high, it's a little higher than market, but that's a function of the rents being a bit high. We think that ultimately the resulting value coming from a 5.5 cap makes more sense in this case. So I will make that adjustment verbally to you. So that indicates a value of $2,543,000. We have, I think, pretty thoroughly gone through our cap rate assumptions. We've provided you with our calculations in all cases. We've showed you where the source of the information came from, and ultimately, for a property such as this, well maintained, good location. It is now. I did notice that this is the corner of Rothesay and Pawfeld. This little corner is surrounded by rentals, but the overall neighborhood is a good established suburban neighborhood. So no adjustment for location or external factors, but we should be conscious of the fact that it is surrounded by a number of rentals, which is fine, but just something to note. Again, good condition. So we are making an adjustment, a positive adjustment to 5.5%. You can see that that's our baseline for 1970 to 1989. And again, we would typically adjust upward, but on a site-specific review of this property, 5.5% makes sense in our eyes. So we are suggesting a value of $2,543,000. Balance of the brief includes some photos, the income workups that have informed our position on the on our chart, our stabilization chart. So all that has been provided for you quite clearly. And I think that's about it, Mr. Chair. It's simply a question of using a cap rate that is not modeled, but rather applied on a site-specific analysis and using the actual stabilized income and expenses. So once again, we are suggesting a value of $2,543,000. And that is my presentation on 1415 Rothesay, and I'll leave it there. Thank you very much.
Okay, now we will I guess we'll have questions first on your main presentation, then we'll deal with your rebuttal. Okay, so Ms. Tang, questions on your main presentation?
I guess I just have one. So I guess on page 19 of your brief, when you shows the workup, that is a 3-year stabilization calculation?
We have used 3 years of data to stabilize. Yeah, that's correct.
Okay, I don't have any further questions.
Okay, and Ms. Duncan, any questions on the main presentation?
No questions, thank you.
Okay, Ms. Anderson?
Just to clarify one question, Mr. Story, when you adjusted to 5.50% for the cap rate, did you apply that to your proposed NOI of 139,877 or the city's NOI of 141?
I'm sorry, we just lost the screen there. I think you asked if the adjustment was to my NOI?
Yeah.
Yes, indeed. Yes, indeed it is.
Okay. Okay, thank you.
Thank you.
All right, so then has everyone accessed the Mr. Story's rebuttal? It should be in the file there. Okay, Mr. Story, so you can begin your rebuttal.
Thank you, sir. Okay, and I will be expedient, but effectively, the city of Winnipeg's cap rate sales are indicating cap rates of 2.9 to 5.75. I have mentioned that given the economic factors at the reference date, just to talk about that first one, and I suppose anything that's below 4.5, it gives us some pause, Mr. Chair, and it would give an investor pause if we were to suggest that a viable cap rate of 2.99 or a rate of return of 2.99 was being suggested, when it's quite clear that the availability of other investment opportunities would return a greater yield with less risk. So that's a basic economic concept, and we can suggest to you that a GIC at April 1 of 2023 was returning 4.5%. We've included the Bank of Canada printout showing the interest rate that was indeed 4.5%. Now, in terms of the sales, we're looking at 459 Sargent, and the city appears to have used historical income as opposed to what kind of income might be expected by a purchaser. So the MLS listing, which we've included for you, states that the annual gross income is 101,142 with an average monthly rent of 740 per unit per month.
Which
And-
page is this on?
Oh, I'm sorry, this is on page, let's see, 1, 2, 3, this is page 4. So this is capitalization rate sales 459 Sargent Avenue.
Okay,
Yeah, so we are suggesting, Mr. Chair, that the city has used historical income in their cap rate stabilization, and they've not looked to what was put to market or considered the expectations of the purchaser. Now, the MLS listing that was put to the market by the broker is suggesting a gross income of 101,142, and that is of course based on 740 per unit per month. And parking, additional income coming by way of parking of $40 per stall per month for 5 stalls. So when we use those actuals and recalculate that cap rate, with the stabilized income, that cap rate adjusts to 5.79. That makes a lot more sense, in our opinion, than what has been presented. I've included that workup, and you can see it in that's on the next page. Okay, and again, we've talked about rent escalation from the time of acquisition and what was expected from the purchaser, and in this case, that's an escalation of approximately $79 per door. So that is not it's not a major escalation, but that is what would have been expected by the purchaser. On the next page, we've anonymized any details that are related to the seller or the purchaser, but we have included what was put to the market. And you can see it's almost the bottom of the page. Gross income, it's highlighted 101,142. So that's what we've used. I suppose this is our position this cycle and in previous cycles is that the cap rates that we're using should not simply look at historical data, but rather the expectation of the purchaser. That makes more sense. 150 Hendon is the next one that we're rebutting, sir, and that's on the next page. The city has not provided a stabilization. They've not provided a workup, even in their rebuttal, so we don't know how they came to their conclusion. We have had the opportunity to speak with the owner and interview them about their purchase and what they were, what was in their, what their assumptions were going into this acquisition. So we can tell you with certainty that the vendor applied for above guideline rent increases through the RTB, the Residential Tenancies Branch, and they would have based their purchase price on the knowledge that the income stream was to would have been higher than what was historically been presented. We've actually, they granted us the opportunity to use the RTB orders in support of our rebuttal, so we've included that here too. I think this cap rate, I think it's a good one at 5.42%. We may now that we have clear data on it, you may see it in our cap rate study going forward. And that's pretty close to what we would suggest as the baseline for a property such as this, 5.5%. You have our workup and you have the RTB orders. We've also included the 2021 income and expense mailer, and we believe that is how the assessor is determining the cap rate through our detective work on this. But without their calculation, it would be it's guess. But we can certainly tell you in interviewing the owner, when reviewing the application to the RTB, the historic rent would have not been germane to the purchase price, but rather the rents that would have been achieved and that would have been ordered by the RTB upon acquisition are more relevant to the purchaser's motivation and should be used then in the application or the derivation of the cap rate. again, we have, so now we're looking at, right, it's 150 headed, sorry, move forward. Now the properties on St. Mary's and on Arden, these were historic cap rates that were used in the previous cycle. We had rebutted them thoroughly then. The assessor has carried them forward, but suffice to say, Mr. Chair, these are older sales and they were purchased with the intention to renovate. And we support that for St. Mary's. Property manager wrote a letter to Mr. Dupont stating as much. And 32 Arden, we've included the ML or the listing that was put to market, and it does say that they have not been remodeled. So there's also a decision from the municipal board, and it does suggest that we ought to be at least cautious, if not, we should at the very least be extremely cautious with properties that were purchased to renovate with the intention to renovate, because of course, once you renovate those suites, you can apply for above guideline rents, and the income accruing to the owner is different from the historical income. As I mentioned in my discussion on 2390, mathematically, if that top line rent increases, all else held the same, the cap rate then becomes higher. So we don't want to have we don't want to support distorted cap rates based on assets that were purchased with the intention to renovate and effectively raise the rent. So I think I'll leave it there, Mr. Chair, but we do suggest that our cap rates are more in line with considering the purchaser's motivation and not simply relying on stale rents that don't consider the income going forward. And with that, I thank you, and I'll leave it there.
All right, questions, Ms. Sting?
I don't have any questions. It's my first time seeing this, and I don't think there's enough time to review everything in, I guess, 10-15 minutes of the presentation. So I don't have any questions at this point.
Okay, Ms. Anderson, questions?
I have no questions, thank you.
Ms. Duncan?
No questions, thank you.
Okay, I have one question, Mr. Story. You seem to be using speculative incomes that a potential buyer might hope to achieve. Is this a sound practice?
Yes, so that's a great question, Mr. Chair, and we can show you with, for example, Hendon is a great one, because we can show you what they were expecting to achieve and then what they've actually achieved. So I agree, we should not simply look at the asking rents without their proper context. But I would suggest to you that it is indeed a more sound practice to look at the expectations of what would be achieved, and then support that with the facts of what was actually achieved. So in the case of Hendon, we can see what actually was achieved, and it was greater than what was being achieved historically. So I agree. I think what you're getting at is, should we look at a listing and take that at face value? And the answer is not without some caution and not without some intelligent analysis, but we ought to look to the investor's expectation and then follow up to see what indeed occurred post-sale. So in the case of McPhillips, we know that those rents went up, for example. So I think it makes more sense to look at if the exercise is indeed to put yourself in the mind of a prudent purchaser, then you wouldn't use historic income if you knew that it could be elevated or escalated upon acquisition. So we're very careful not to simply use the asking rents or some such thing, but rather to look at the motivation of the purchaser. So we don't look at asking rents blindly, but we do consider that in cases where there is rental escalation, that we should consider escalation as opposed to historics.
All right, thank you very much. Any summation, Ms. Teng?
No.
Mr. Story?
Yes, no, thank you very much, everyone, for your time today. I think we've presented a very cogent position on both of these properties. I think we've been quite fair in adjusting our position on a site-specific review. And I would, once again, give weighted consideration to the Altus cap rate study based on what we've heard here today. And with that, I thank you very much.
Okay, thank you. We've now heard all the properties on the agenda and this hearing is now closed. Thank you, everybody, for your presentations.
Thank you very much.
Thank you.